Welcome, everyone. I am Edward Hertzman, the founder of Hertzman Global Intelligence. HGI is an apparel business intelligence platform delivering deep insights to the entire fashion supply chain from raw materials to store racks. I launched this business based on my experience as an executive for major sourcing companies with a focus on production in Pakistan, Bangladesh, India, Vietnam, and China, which I leveraged to start and exit a prior fashion business publication. If you're not already receiving our Insights newsletter, you can sign up by visiting hgi.io. It's IO. Some housekeeping before we start. We'll be recording today's session, so you'll be able to rewatch or share with industry colleagues later on. Also, if you have a question, click the Q&A button at the bottom of your screen and enter it there. We'll have about an hour, which will go by fast. We'll try to get a few of them going as we go along as well. Now let me introduce today's speakers. John Devine, Senior Economist, Cotton Incorporated. Jess Dankart, Vice President, Supply Chain Retail Industry Leaders Association. John Kernan, Managing Director at TD Cowen. And Kristen Classy Zumo, Executive Director, Industry Advisor, Apparel, Circana. All right, let's get right to it. John Devine, first question for you. I want to cover some of the raw material markets. What are the current headwinds and outlook for the cotton market, and how does U.S. cotton compare?
Yeah, well, I think it'd be a common theme probably from all our speakers today in terms of what the major headwinds are for the industry. And of course, top of the list is going to be uncertainty. It's not just the speed of change, but also the magnitude and breadth of the change that's been out there. In our world, in the cotton sector, of course, we're pretty dependent on trade. Starting at the fiber level, we export about 85% of all the cotton grown in the U.S. every year. And then at the downstream end, about 98 plus percent of all the apparel sold to consumers in the U.S. is imported as well. So there's no lack of exposure throughout the supply chain to changes in trade policy, and trying to digest those changes is certainly is a big factor. I would just say another added on point is a little more specific to some challenges that U.S. growers are facing relative to pricing is that, we have seen some changes in terms of where cotton's been produced and where cotton exports are available. And a big story on that front has been the rise of the Brazil over the past couple of years, with them shipping about three times as much cotton as they did about 10 years ago. So, on top of all the trade policy issues, we have all this additional cotton, and that's creating some competition, and that's all contributing to some of the weakness that we've seen in prices here over the past year.
Well, as a follow-up to that, John, as the price of cotton, with the price of cotton so depressed, what impact does this have on farmers' decision whether or not to plant cotton or switch to another crop? And what does this mean, as we look a year or two out as it relates to pricing and supply?
Yeah, an unfortunate thing out there in the agricultural sector right now is that all prices are down. So if you are a producer, there's nowhere to hide. Corn prices are down, soybean prices down a little bit, and of course, cotton prices down as well. So on top of all that, we've got the uncertainty of trade policy affecting these markets and the outlook. So a lot of questions out there, but no easy answers. I think a lot of our producers will probably look to rotational issues, trying to keep their soil health up, and probably let that guide their acreage decisions. But generally, not expecting increases in acreage given these low prices we have for cotton right now.
Well, to add pain to this, we're seeing man-made fiber, those costs continue to decrease and the capacities are going up. So is this impacting cotton demand at all, or is it relatively flat?
Well, I think, we're all swimming in the same sea to a certain extent. So global fiber demand is affected by global apparel demand.
Mhm.
And global apparel demand is affected by the economic situation, which is being affected by uncertainty in the trade policy. So all that's putting, some headwinds out there in terms of demand for all fibers. But of course, there is fiber price competition, and, something that we would like to see in the cotton industry as a natural fiber is that some of these man-made petroleum-based fibers are priced accordingly to their environmental costs as well, which I don't think are adequately incorporated into the price of those fibers.
So, John Kernan, I want to switch over to you. I know you spend, all day really speaking to management teams and boardrooms about, how they're navigating these difficult times. And what insights do you have? What is really happening behind closed doors as it relates to the sourcing map? Are brands and retailers, are they setting up production in new countries? Are they moving to different regions? Are they staying still? What are they telling you?
Yeah, there's unprecedented uncertainty on costs and pricing as we head into holiday. there really hasn't been a change in or articulation of a change in strategy. Our companies in US retail, the retailers, the vendors, the apparel manufacturers, the footwear manufacturers, they're all extremely levered to Southeast Asia. And there is no change in strategy around that. We're not hearing of any nearshoring. I think right now the strategy is to attempt to mitigate as much of the tariff cost as possible. Some of that comes with the factory partners eating some of it. Some of it's going to be the consumer. Some of it's going to be the companies. But it's an unprecedented cost headwind. The biggest company in our space is Nike. They face a $1.5 billion tariff, gross tariff impact hit this year. That's a lot of money. And there's costs going to be shared with suppliers. There's going to be costs eaten by consumers, and there's costs eaten by the companies. But back to your question, are people openly talking about moving their supply bases around? No. I think this is an industry that's just become so embedded in Southeast Asia and the low cost labor in that region. Right now, there really isn't an alternative. And you're seeing um, a lot of innovation in supply chain around some of the factory direct consumer models, and but it's all emanating out of Asia. Southeast Asia is where this supply chain starts and ends, and we really haven't heard much of anything in terms of strategy shifts around that.
So, Jess, let's talk a little bit about logistics and how that's been impacted by, you have tariff-induced, surges, and then you see it kind of, bottoms out and shipping demand. Are we likely to still feel the aftershocks in terms of prices or capacities in the coming months as it relates to logistics?
Yeah, absolutely. I mean, I think the volatility that we're seeing, and John both touched on the uncertainty, as long as we continue to see that level of uncertainty and a difficulty of planning to any sort of longer time horizon, we'll continue to see the volatility play out in logistics markets as well. I mean, the shipping supply chain rhythms in this year have really been very different from usual. And that's saying something because the last, 5 years since 2020, we've been continually kind of in supply chain disruption of one flavor or another. So the last, 9 months haven't been a surprise particularly. We knew that there would be, a disrupted trade landscape, but I don't think that companies were as prepared for the scale and cadence of what we've seen, and consequently, that's caused a lot of shocks in the transportation markets. And like I said, they'll continue. You talked a little about that uncharacteristic surge that we saw kind of early in the year and in the first quarter, as a lot of companies were trying to beat those earlier tariff deadlines, a lot of front loading, although not all companies were doing that front loading, not all the retailers. But big surges then, and then, in April, things just really ground to a halt and imports fell off a cliff. I mean, I think it was the largest monthly decline on record. So,
Wow.
the shipping markets, the ocean shipping, air freight, they've all responded to these really volatile shocks in the movement of merchandise, of goods, and the rates have followed along with that, volatile rate picture. Ocean carriers have really tried to stem that sliding rates, even as they're seeing more capacity come online. And the early fall peak season that we normally have happened more in the summer and was, modest at that. So the ocean carriers, air freight, all the kind of carriers out there are really staring down kind of a pretty disappointing fourth quarter of 2025, at least through the end of the year, expecting imports to continue on a lower and declining basis. And certainly, with these weaker rates and no shortage of capacity out there, carriers aren't in a hurry to add more capacity by, going back into the Red Sea or other moves that would continue to pressure those rates in a downward direction. So the logistics markets are kind of limping along from that standpoint. Domestically, the same thing. The trucking market has been depressed for a couple of years now. And with the lower volumes of goods moving internationally, that translates to domestically as well. And not seeing any kind of promising uptick there as well. And it's certainly not helping to have kind of additional heavy truck tariffs announced last week that'll set to add costs to the system as well. But I think as long as we continue to see this uncertainty, we'll continue to see that volatility in transportation markets and with the global flow of goods.
For those that are listening that are now, everyone's planning 26 budgeting and whatnot, when it relates to trucking, air, sea, warehousing, would you project that it's going to be relatively flat over the next year? Do you know, would you plan it down, up, if you just had to look in your crystal ball?
Yeah, I think a crystal ball is something that everybody would like to have. I think because of the that uncertainty and this the kind of wariness of trying to make any sort of significant long-term plans, you'll see not very much kind of aggressive behavior around making kind of really big investments or plans, whether it's in warehousing or kind of from a transportation market standpoint as well. I think everybody's in such a reactive sort of mode, waiting for kind of the next announcement or what the next kind of change will be, that it makes it difficult to have any sort of longer time horizon with planning. And that kind of chills the interest among businesses to kind of make those bigger long-term bets. So really looking at kind of hedging existing bets and looking at contingency planning, building those contingency planning muscles and kind of having supply chains that are able to respond to whatever the particular next shock might be and kind of are built for a number of different outcomes. And to kind of do what you can with the pieces that you have in place and ensuring that you have the pieces in place to try to be responsive in this sort of continually disrupted supply chain landscape.
Just a question for you as well. I know we asked John, is he seeing a lot of diversification or changing in the supply chain? You represent obviously so many retail companies. What are they saying? I mean, are they staying? Are they diversifying? Are they planning their sourcing, their inventory, their logistics strategies any different? Is it like John said, very much the same, very much low cost, mentality coming out of South Asia? Um,
Yeah, I
and,
think
and if
it.
you're, and if you're shopping, like, are you going to start to see a change in the product quality? Are you going to see things get just more basic? Are you going to see the labels are going to see different countries? Like, what are the consumers going to expect to see this holiday in Q1?
Yeah, I think as John said, things are very much kind of focused on a particular area of the globe, and while there are instances of kind of looking elsewhere or evaluating nearshoring or some of the shifting going around, because really that sourcing footprint, leading retailers are always kind of evaluating that. It's not something that just started on January 20th of this year. That's an ongoing process that retailers are continually looking at from a their product mix and the cost standpoint and how that affects supply chain and transit times, all of these different variables that go into those decision-making calculuses. And then, this current kind of disrupted trade landscape is another factor to that, albeit a pretty significant factor. That's an ongoing process in terms of needing to kind of reevaluate those sourcing conversations. But to John's point, there is such an undeniable and kind of critical mass of sourcing that happens in a particular, region in Southeast Asia and kind of broader, in that Asia and India and kind of that aspect. And given that continuing uncertainty of, do you want to make big investments to move to another region or another country when you don't know if there are going to be kind of other announcements around, potential tariffs or trade impacts that may come up, down the road later this year or next year or whatever the case may be. There's had a hesitancy to make kind of big movements on that, but certainly kind of testing the waters and evaluating, and it is, as I said, kind of an ongoing conversation, but really leaning back on kind of these contingency planning and looking at different scenarios, how you can build supply chains that can be responsive in that way, but a hesitancy to make kind of big moves because of that critical mass and kind of the existing sourcing footprint and just the uncertainty and the effect that that has on really wanting to kind of really stick out there and make big decisions in such a volatile and uncertain time. As far as kind of the consumer impact, I think at the end of the day, retailers have really focused on that North Star of the shopper experience and ensuring that regardless of whatever upstream disruptions may happen, ensuring that, the guest, what the guest wants is on the shelf or on their doorstep, when and how they want it. So they've been, I think, remarkably able to insulate the end consumer from a lot of these shocks that we've seen, these kind of ebbs and flows and wild whiplashes in kind of global supply chain picture. There hasn't been, a significant effect on kind of store shelves. And that's a testament to not just the retailers, but I think they know the entire ecosystem of retail supply chains to insulate that. But the longer this uncertainty continues, it's kind of an open question of how long it's possible to continue to do that.
So, John, I want to go back, turn into something you said earlier about how the retailers are just trying to really mitigate the costs, due to tariffs. But I want to know how much visibility or how much are the management teams talking about? What are they going to eat? How much do they expect the factories and supply chain partners to eat? How much is the consumer it should be expected to kind of what is that going to look like on price tickets? What can you just elaborate a little bit on what you're hearing?
Yeah, companies have been vague in terms of what they expect to eat themselves, what their factory partners are going to share, and what the consumer is ultimately going to bear. But I think when you broadly look at the retail ecosystem in the holiday, there's companies planning AURs up as much as high single digits. And depending on your source of your mix of sourcing and your mix of geographical revenue, if you're a company with 50% of your revenue in the U.S. and you're facing these new tariffs, you can offset most of that hit with a roughly mid to high single digit realized price increase. And the consumer has to eat that. And there's certainly going to be some elasticity that has to get factored in. But the forecasts around this are extremely difficult because we just haven't had a period like this before in terms of the COGS pressure, in terms of the pricing pressure, where everyone or most companies are taking price at the same time. So companies have been cautious to issue guidance. They've given wide ranges of outcomes, and you can see why. And I think this quarterly earnings season is going to start very shortly. You're going to really start to get a better view as the initial hit, because the first and second quarter, we were still cycling lower cost inventory through the income statement, through the cost of goods sold. Now in Q3, in the first half of Q4, the first half of next year, all the goods that have been sourced in the higher tariffs are now going to start to flow through. So you're going to start to see some real outsized gross margin impacts. You're going to see some surprises to the upside and downside when a lot of these companies report. And you're going to see, like I said, pretty wide ranges of guidance on a net impact to the gross margin. And the consumer in certain areas is going to eat some of these costs. I think pricing is not going to be broad-based. Companies are going to try to be surgical and target specific SKUs and franchises. And you'll see bigger price increases there and maybe no price increases elsewhere. So a lot of uncertainty you're going to hear from a lot of companies starting next week. And it's going to be fun trying to forecast some of this as we get into the first half of next year, because a lot of this carries over into the first half of next year from a cost of goods sold pressure for both the companies and the consumer.
Kristen, what does your data tell you about price increases to date and what impact these have had on consumer spending?
Yeah, so prices are increasing for the consumer. We're starting to see that already. So for the first few months of the year, prices were actually consistently coming down. But really, since May, we've seen gradual price increases in apparel. And again, this is just specifically talking about apparel, about 1% to 2%. What's interesting is there's a lot of nuance to what is happening right now. So I really try to not paint broad strokes, because we could be seeing a shift in promotion, a shift in category mix, brand mix. When we look at the data, really the biggest driver of price increases so far is new items. So new items in the market, more expensive now than they were a year ago. And that makes sense. John talked about this, how we're seeing brands and retailers really be more selective and strategic about where they're taking price. It's not consistent across the board. They're likely to pick new items. Consumers really don't have a strong baseline of knowing, what this pair of wide leg jeans might have cost a year ago compared to, let's say, a 6-pack of underwear that they're buying, every 6 months. So we're seeing prices are increasing since May, mostly coming from full price new items. Now, we do know as a result, even if consumers might not have a baseline, about 3/4 of consumers are expecting prices to go up from tariffs. And specifically when it comes to apparel, about 80% said that they're going to change their behavior as a result.
So what is, as a follow-up to that, what is that changing of behavior that they're suggesting they're going to do?
It's nothing new. I would say it's an acceleration of what we've been seeing really since inflation. So if you think about it, consumers have been dealing with price increases. They really had 2.5 years of inflation. They haven't had time to really adjust. Now we're seeing those prices come up again. So it's an acceleration of those behaviors that we started to see a year or two ago. Consumers are holding back and trading down. So some of the first things we're seeing is just a pullback in demand, right? It's this inverse relationship. As price comes up, we see demand come down. So it's really the first thing that we're seeing. We're also seeing a shift in where consumers are shopping. Off price, resale, private brands. So these areas are outpacing the market. And what's interesting is that consumers aren't really seeing these as options. They're really not seeing them as trade down, right? They're seeing them as ways to save. But from our surveys, from our data, consumers are consistently telling us that they feel that private brands have just as good value and quality as a national brand. They see resale as a smart way to shop, not just for luxury brands, but for everyday brands. So we're seeing this channel shift that started a couple of years ago, but it's really being accelerated by this fresh set of price increases.
Kernan, as a follow-up to that, when we think about holiday and spring, are you seeing any impact to the type of goods? Kristen kind of alluded to more private brands. People are maybe trading down a little bit. What are they telling you in terms of how they're changing their assortments moving forward, if at all?
Yeah, I mean, Kristen nailed it. Off-price, private label, particularly Dick's Sporting Goods, has had tremendous success. There's a shift. There's shifting value perceptions among consumers, and the companies we cover and all the retailers and brands out there have to address that. And we have seen trade down. We've seen acceleration in traffic at the off-price retail level really since back to school. We think they're set up for a very good holiday. The retailers, I think, are still in a test and learn, and the brands as well, in terms of how the consumer's reacting to certain promotions, certain pricing. Like Kristen said, a lot of the price increases you're going to see are on newness and new franchises and innovation. And they're still in test and learn. I think this is going to be one of the harder holidays for a lot of CFOs and finance teams to plan for. And we had a great holiday last year. The consumer showed up. It was a shortened calendar, and the consumer showed up, and almost everybody was on plan. There was a lot of upside to companies' Q4 outlooks, and we've got a tough compare from this holiday. Hopefully, seasonal weather starts to agree a little bit more, and there's a lot of uncertainty out there. But the winners right now that we see are the value positioned retailers, and certainly private label has been a big gainer as well.
So just, John, another question for you. You called me after a bunch of the quarterly earning calls a couple months ago, and you were surprised at how exposed so many companies were to de minimis, moving warehousing to Mexico, Canada. Now with this being phased out, what does this mean for margin? What does this mean for pricing? Like, what are the retailers telling you?
Yeah, the most visible hit to de minimis, at first came from the de minimis exemption being, going away, was Shein and Temu took a big hit. But we look at a lot of their e-commerce traffic and digital engagement numbers, and they're still very strong. I think the most recent public company that spoke about the hit from de minimis was Lululemon. They're obviously a Canadian domiciled company. They have almost 50% of their mix is done online. They were shipping a lot of their goods from their huge Canadian DC into the US directly to consumers. Roughly a $2 to $2.5 billion duty-free business they had. The hit to that is tremendous. I mean, it was roughly a 250 basis point hit to their gross margin, and that P&L is not coming back. I don't think you can price around that in this environment. There's other companies that have taken the hits as well, and I think trade policy with the Trump administration has been volatile. It's going to stay volatile, and I think you're going to hear a few more companies talk about de minimis, and I don't know if the hits will be quite as large as the one we saw from Lululemon, but there's certainly still a lot of DCs in Mexico, a lot of DCs in Canada that were taking advantage of the duty-free treatment.
Kristen, there's a question from the audience, and they're asking if you're seeing a change in consumer behavior post de minimis.
We're starting to see, the fast fashion in the data, that channel we're starting to see a little bit of a pullback, but again, it's when you dig into the nuance, some retailers performing better than others. Again, I think de minimis itself, the consumer might not really know how that's impacting them. I just think we're continuing to see it. I think other retailers and brands have an opportunity to lean into where we're seeing a pullback in de minimis. I think consumers are still going to be comparing prices online. That's one of the biggest things we'll see this holiday. And I just think for brands and retailers that might not be affected, it's a big opportunity to just lean in, especially when it comes to that price.
John, as a follow-up to that, because I agree 100% with Kristen, I don't think consumers really even think about this very much. Has there been any indication from management if there's going to be a deprioritization of some e-commerce, trying to drive people more into brick and mortar? Has strategy changed at all, John?
I don't think people are making, I don't think management teams are making wholesale changes. They certainly have to take the cost hit of not being duty free anymore. And there's not much they can do about that. That's a permanent hit to their margin structure. And I think a lot of folks in the investment community were surprised at the size of some of these duty free businesses. And um, the consumer, I don't think that they're planning to adjust price significantly to offset this. The consumer is probably not going to know in a lot of cases, certainly with the Shein and Temu's of the world and the factory direct consumer models. I think prices have risen there, and it's visible when you go from a $6 blouse to an $8 blouse. But again, it's all about value. The consumer is very conscious of value. They're comparing prices constantly online, and there's not much you can do from a pricing standpoint to offset the de minimis hit. And I think certainly companies are reinvesting in DCs and supply chain. We see a lot of CapEx dollars being spent this year on supply chain across retail. They're building bigger DCs, more automated DCs, and they're increasing their capacity, DC capacity here in the US, and they have to. They have to get faster. They have to get more automated. And that's what you're going to see. You're going to see a shift away from some of those foreign-led DCs and probably some more distribution center investments here in the US.
So, Jess, the problems seem to never end here. So, we're facing a tit for tat on shipping port fees between the U.S. and China. How concerned do brands and retailers need to be about this? Is it likely to add significant costs? Maybe you could just talk a little bit, about what this tit for tat kind of, fighting it between U.S. and China has been as it relates to shipping port fees.
Yeah, absolutely. And I think, John brings up an interesting point about the growth of automation in retail DCs and whatnot, because we saw, just recently an announcement of a 232 investigation into robotics, which threatens to add tariffs to some of the automation that has been a cornerstone of, in improving the effectiveness and ability for retailers to do that shipping domestically and in those distribution centers. So another potential opportunity for injecting more cost into the system. And similarly, that's, kind of what we're seeing with the port fees as well, these kind of dueling port fees that USTR had announced, resulting from an investigation that had started under the previous administration, but then the kind of tactics or the methods to address this coming out in the current administration, and looking at, these looking to kind of divert the attention from the Chinese shipbuilding industry and to ostensibly, regrow the American shipbuilding industry. But what we see, in practice is these ship fees, which have, taken effect last week on both sides. So far, the immediate impacts have been pretty minimal. We haven't seen a lot of congestion or widespread confusion at U.S. ports. There have been some delays reported at Chinese ports, but really more among kind of bulk ships rather than container shipping that, retailers would be using. The overarching concern is just that, this is all just one more thing. It's one more injection of disruption into the ocean shipping market and into supply chains, disruption and costs. So, a lot of the carriers who've been on both sides, on the China side and the U.S. side, with the port fees on either end, looking at, shuffling their fleets to move different ships to different routes, and, changing their executive leadership based on kind of ownership and exposure, trying to mitigate exposure from that standpoint. And certainly, container lines have had differing responses on whether they plan to pass the port fees along to the, U.S. cargo owners, the importers. But, at the end of the day, whether or not there's a line item on your bill saying China ship fees, the new fees, this disruption, the distraction caused by all of this compliance efforts is all adding cost to that equation. So just yet another, instance of throwing another, wrench into the normal and smooth functioning of supply chains. But as far as kind of that immediate impact of, huge surges in prices and capacity impacts, not a huge impact there, but really more just a question of kind of overall, it's more cost being injected into a system where retailers are trying to take cost out, and just the difficulties around kind of the market and capacity issues that we see, and just kind of another brick in the wall of challenges for supply chains.
So talk about wrenches. Can you explain to me, Jess, what this new heavy truck tariff is?
Yeah, I think it's looking at again trying to in keeping with kind of the broader philosophy of the administration around using tariffs as a tool in their negotiating toolbox with respect to this. I think a lot of while a lot of the trucks are heavy duty trucks are maybe built in the U.S., there is a lot of movement across borders, particularly with Canada and Mexico. So a lot of, there had been an initial kind of threat of heavy and medium duty truck tariffs. Now it's been moved and kind of additional clarification on the details to that came out last Friday. All of this set to go into effect on November 1st. As I said earlier, the trucking market has been depressed for a couple of years now, and this is again just another example of kind of another potential cost added to that. Added to, the trucking companies are already facing a lot of operational cost pressures. We've seen, I think, a significantly high number of bankruptcies just in, kind of the last couple of quarters in terms of trucking companies. It's just a challenging line of business to be in, and adding more cost to that in the form of additional tariffs, making it less possible for companies to, add capacity or to replenish older trucks and bring new trucks into their fleet. Just a lot of challenge there to add with this, the heavy truck tariffs. So just something else that's kind of exhibiting this downward pressure on these transportation markets. But again, a lot of kind of open questions as we're in kind of the process of reevaluating and revisiting the USMCA, how that plays into things. Some of the stipulations on the heavy truck fees have to do with USMCA valued parts and that sort of thing. So also kind of a moving target as things continue to develop, but certainly something that will, as of November 1st, will start having an effect on new truck sales and capacity.
John Devine, question for you. Can you explain the part of the tariff executive order that says if brands and retailers are using at least 20% US inputs, they will reduce the amount of duties owed? How does this work? And is that a significant enough to make a material difference for people to actually try to, import this cotton overseas and whatnot?
Sure, yeah, something that I think flew a little bit under the radar given all the other changes that have been out there, but something that was in a paragraph of that April 2nd executive order was the statement saying that if a good contains at least 20% US content by value, then that proportion of US value is not subject to reciprocal rates. So that's all a little bit of a mouthful, but really what we have is a threshold. Do you have 20% US content? If so, that 20% plus of US content is not subject to the reciprocal duty rate. So in terms of the benefit to that, it's a little bit of math. So if you guys just bear with me, I know it's some mental math, but we're multiplying percentages here. So just for example, if you've got a 25% US content by value and you've got a 10% reciprocal duty rate, that's going to give you a 2.5 percentage point break on your duties that's being paid. So in terms of percentages of benefit, it's not huge because you're multiplying decimals, but if you're dealing with large volumes, that's something that potentially could be beneficial. So the question about how applicable it is beyond just the number that we have for return is also how do you qualify? So are you going to be able to get to that 20% threshold? And if so, how are you going to approve US content? Taking a look at the US cotton sector, of course, we export 85% of our fiber overseas every year, and a good proportion of that comes back in terms of finished apparel and finished textile goods. So I think there could be some opportunities for retailers and brands to look at this as a way of helping to reduce their tariffs. But a challenge when we take a look at fiber value relative to landed cost of goods is that generally somewhere around that 15 to 20% level. So it's not necessarily easy to qualify to get there. But I think if you have more basic goods that you're bringing in, it should be more easy to qualify for that reduction. And if you do take a look further downstream, instead of using fiber, you're looking at US yarn, should be pretty easy to reach that hurdle and potentially reap that benefit.
Another question for you, John, and obviously I'd love to hear from Kristen and Jessica on this as well. Why has apparel inflation in the US market been so much lower than the top line inflation we've seen? How have they been able to mitigate this? Any thoughts on this?
Well, I mean, I think, when you take a look at the apparel market, of course, it's been very cost sensitive over the longer term. And I think retailers and brands and manufacturers have all gotten, pretty experienced in terms of how to deal with cost pressures. And I think they're aware that there's a lot of discretionary items that are out there and some price sensitivity. So I think, experience has been a tool that has maybe helped them manage some of this cost volatility in the near term. And I would say, something else that we've been facing here more recently too, in addition to the longer term downward movement that we've seen in retail prices for apparel relative to over the overall CPI is that we got to consider economic factors too. We take a look at apparel, we're about 2% of overall spending. If there's increases in costs for housing, food, energy, where's that pinch going to be felt? It's going to be felt in the more discretionary categories such as apparel, and we've had to be flexible for that reason on price.
Kristen, Jess, any additional thoughts on this?
No, I think, John really hit it. We continue at Circana, we track complete consumer spending. So we're not just looking at discretionary, we're looking at food and CPG. And I mean, we've continued to see spend on food, grocery, CPG outpace discretionary. That is absolutely where we've been seeing the pullback. Consumers have to prioritize their share of wallet and where they're spending, and that has been defaulting to necessities. Additionally, too, in terms of inflation, I don't know if that question was more directed to just the latest round of price increases and tariffs, but I mean, we forget right after the pandemic, we saw huge growth in apparel prices. I mean, for about a year or so, it was double-digit growth. And even if brands and retailers weren't impacted with inflation, we saw there was a willingness for consumers to spend, and many brands raised their prices in accordance. So, we're already coming off of some pretty steep price increases in the not too distant future. There was a little bit more wiggle room for margins. So that's why I think we've kind of seen that slow down a little bit. But in the recent history, we have seen some pretty high increases overall in apparel.
Yeah, and I can just add, just from a supply chain standpoint, it's been an ongoing effort to take cost out of the system in terms of the supply chain and all of the pieces of the transportation part of that. So being able to kind of offset some of that, again, in order to try and insulate as much as possible consumers from the impact of these fluctuations in inflation and otherwise. Retailers are really sensitive to how, particularly with apparel, that there is a lot of that is very discretionary, and being sensitive to that, making sure that they can address as much as they can of those cost impacts without having to pass that along if at all possible.
Before we go to the next question, John Kernan did need to hop off at 11:30, so I want to thank him for his time. If anyone has any questions for him, just put them into the chat, and we'll get them over to him and do our best to follow up offline. Kristen, you mentioned share of wallet. Where does apparel rank in overall terms of share of wallet, and where are the bright spots? Are you seeing wellness, health? Is there anything else that's really starting to grab that consumer dollars that maybe would have gone to apparel in years past?
Yeah, absolutely. So, apparel has had a larger share of wallet in years past, and we continue to see that share shrink to other categories. You talk about health and wellness. I mean, beauty since the pandemic has consistently stolen share from apparel. In times of inflation, uncertainty, economic stress, where consumers are prioritizing food and needs, beauty continues to grow. I think the industry taps into newness, innovation, joy, health and wellness, something that is checking all the boxes of value with consumers. I think so. Beauty, absolutely, I think a growth driver, and it really has hurt the industry. Again, I think there's been this health and wellness boom. It's kind of shifted as to what it's looked like. I think it was more about being natural and more about longevity, GLP-1, weight loss. I think there continues to be this focus on health and wellness that might be shifting in definition, but we know it's grabbing consumers' interest and consumer spend. And let's not forget, health and wellness, beauty, these industries have just led in terms of innovation. Apparel, we talk about newness and trends and consumers being very selective. The industry suffers when there is a lack of newness and trends. So while we talk about the importance of focusing on tariffs and supply chain, and we know businesses and brands are focusing so much, finances and resources, you cannot forget about newness and innovation, because without that, the industry is really going to be stagnant.
Mm-hmm. Kristen, there's an audience question. They're asking, what is the consumer price index going to show us on Friday?
I might divert that to the other panelists. I can't really. I'm focusing on apparel. It might be a little bit above my head, and if I had that answer, I might not be here right now. But overall, yeah, I'm not really sure what CPI might look like.
Okay. Jess or John, is that something you guys could speak to, or we'll go to the next question?
Well, we just hope we get a CPI number. We're still in shutdown mode, so are we going to get any numbers from government anytime soon? I think, it's something that we're all looking forward to getting these data points to play with again, but unfortunately we're on pause. So
Yep. That's a good,
Yeah,
actually,
great point.
that's a really good point, actually. John, a question for you. So, 2 Fridays ago, we had this new threat of 100%, additional 100% tariff on China. Then, it's kind of subsided. Whether this happens or not, it's a good reminder that things could change at any time. One day India had an advantage, then the next day it doesn't. How is this, or if at all, does this increase uncertainty? Does it impact raw materials at all? Does it change the pricing, the demand, the capacity, what farmers want to do, or is this?
Well, say for the example of China, I think a lot of this is already baked into our cake. I think even before we started having these tariff announcements, maybe even a year out, the traders and participants in the commodity markets were anticipating maybe another round of trade dispute even before the election results came in. So I think there maybe was some positioning there. And then I think, since we did see some tariff announcements being put into place, I would say specifically some of the retaliation that China put into place starting in March when they increased their tariff rates on U.S. cotton. We've essentially been zeroed out of that market. So if we have, paying 25 percentage points in terms of additional tariff, we're not selling any cotton to China right now. So if it goes from 25 to 125, I don't know that really changes the situation too much. I think where there could be some indirect effects of that could happen downstream. We take a look at polyester production, about 60 to 70% of it is coming out of China. We take a look at apparel sourcing, the percentage of cotton dominant apparel coming from China is less than 20%. You take a look at the proportion of man-made fiber coming out of China, it's closer to 50%. So if we do see, some movement in these tariff rates more specific to China, there could be some impacts there at the fiber level due to the way that tariffs are applied at the garment level in the U.S.
Nice, John. Jess, a question for you. I feel that the apparel and retail sector is a more resilient, category, whether it's geopolitical or natural disasters or all the tariff changes. I feel like we've gotten a lot of practice on how to deal with this over the years. So they're pretty good at dealing with sudden shocks. Is there a role that AI or other technology could play in forecasting, strategizing, helping to smooth out some of these sudden bumps around, in the road? And what degree are we seeing merchants and companies leaning into technology? Are they embracing it the way other industries are?
Yeah, I think absolutely in terms of, just the need to, what we've seen over the last handful of years, I think the pandemic really put things into a steep acceleration in terms of needing to focus more on that contingency planning and building these more nimble, responsive supply chains. There's been varying degrees of disruptions pretty consistently since 2020, so there's not been even a time to sit back and relax. So in that kind of environment, retailers have really focused on um, building those muscles of that kind of contingency planning place. And a lot of that's technology enabled for sure. I mean, the latest changes in the trade landscape are a huge disruption, but kind of the latest flavor of disruptions. And so what we're seeing is certainly in terms of forecasting and planning inventory strategy. It's basically table stakes at this point to be doing that with some sort of technology enablement. AI, I think, pretty much any sort of solution that's out there is going to have some form of some degree of AI and machine learning employed in terms of the forecasting and planning piece. And that gives retailers just so much more ability to plan and include so many more variables into that forecast and into that inventory plan. All these things that might influence planning, pulling from internal data as well as external third-party data sources, things like economic data, weather, population movement, all these different things that help build a much richer picture in terms of a forecast, or rather pictures, because we're looking at these multiple different possible scenarios to compare and assess among those. And certainly looking at exploring the possibilities of AI, I think as I said, table stakes at this point to be including some sort of technology enablement with that. And I think where the really exciting opportunities that we're seeing are where retailers are exploring this agentic AI for supply chain planning and putting in place these agents that are taking all of this data and making decisions with kind of human oversight, obviously, and the degree to which that can continue to make the supply chains more responsive and able to react to these different shocks and disruption that we continue to see. And such a key element. I'll never be perfect. The entire idea of forecasting and demand planning is such an interesting blend of art and sciences. Every year RELA has a retail supply chain conference in each February. We bring together a bunch of retail supply chain executives. One of my favorite sessions from the inventory and demand planning topic was just called, kind of tongue in cheek, but getting it less wrong. And that's kind of what we're, aiming for at this point, is better forecast, better planning, better ability to kind of pivot that planning. And AI is kind of a key part to that, and a lot of exciting kind of frontiers with regard to the kind of generative and agentic AI that retailers are exploring.
So guys, there's another audience question, and it's if we do get job numbers, can we expect a direct correlation to consumer spending for discretionary for a direct correlation to consumer spending for discretionary like apparel yet? I'm not sure what they're trying to say there. But is there a direct correlation between job numbers and consumer spending as it relates to apparel if we get those job numbers? Can anyone speak to that?
I'm going to take a first stab at it, but I think it's all pieces of a bigger puzzle. So I think a story that has been helping support consumer spending over the past couple of years is that inflation continues to be high, but wage growth has been outpacing inflation, and whether or not that's going to be able to be sustained or not. Obviously, these latest payroll numbers we've had have been pretty weak. And we haven't seen wage growth drop off a cliff yet, but if we do see the labor market soften a little bit more, I think that element that has been a source of support for consumer spending probably could expect to get a little bit weaker.
I think that's a very realistic prediction of what's probably going to happen if that continues to be affected. Chris, and I have a question for you. It seems that a lot of companies right now are blaming tariffs, uncertainty, geopolitical issues for, let's say, weak performance. But the reality is some of this has nothing to do with that. Maybe a brand is losing market share. XYZ brand is losing market share to a Hoka, an On, or an Alo, or whatever. And maybe the tariffs are making things worse from a margin perspective, but the consumer demand has weakened for X company. Or is it, as a sector, less people going to a department store because they rather go to a gym or rather invest in GLP-1s or a wellness tourism experience? How much of this do you think is directly correlated to a change of consumer preferences or versus just, tariff impact?
Yeah, I mean, Eddie, you don't want to waste a good crisis, right? Why not? Why not blame tariffs? I definitely don't want to diminish, of course, this whole conversation is about how this is impacting, this real impact to the industry. But again, consumers, they're just being more selective. They haven't stopped shopping altogether. So I think the brands that are really understanding the value that their consumers are buying into, they're understanding newness, they're understanding trend, they're checking all the boxes. They're the ones that's winning. There's a big bifurcation in the market where you see that brands are doing well, and it's premium brands. You mentioned On, Hoka, premium running brands, Alo, activewear brands. So I think it's, again, I mentioned earlier, nuance. We cannot paint broad strokes, there is so much nuance to what is happening in the data and consumers' preferences to where they're shopping right now. So for a brand or retailer, you have to kind of go a little deeper. You can't, just focus on an active tennis skirt, knowing that people are buying activewear. How are you differentiating yourself and creating that value that's different than a private brand? How are you focusing on quality? How are you messaging what really separates your brand from that other private brand, that lower price brand on the floor? One of the things I also talk about is, again, consumers, those traditional seasonal holidays, yeah, they're still important, but there's so many other outfitting opportunities that I think the industry is ignoring. Okay, yeah, there's Christmas, there's Easter, there's Mother's Day. Okay, it's still important, but what are those triggers that are happening, like the Super Bowl, right? How are you partnering, maybe thinking about some sports licensing? So for the past 5 years, NFL apparel has grown at a 4.5% CAGR the 2 weeks leading up to the Super Bowl. Kentucky Derby. We see, dress sales have been a little stagnant, but the Kentucky Derby, the week leading up, it's the third largest dress sales week of the year. Younger consumers, they represent about 24% of activewear growth. Well, think about that Gen Z, woman who's going back to college. She's maybe looking for a wardrobe refresh. She has events that she's buying for. Think about the outfitting triggers. I think the brands and retailers that are winning are communicating their value. They're really strong and clear on their messaging, what sets them apart, and they're leaning into these outfitting triggers throughout the year.
Kristen, one thing I've heard from a lot of buyers is that a lot of wholesalers and brands are playing it safe. There's not a lot of new and freshness. It almost seems that the brands that are willing to really invest in R&D, invest in design, take a chance, bring something new and fresh to the market is going to win. If you're just replenishing the same stuff or trading down or making cheaper product because you're concerned about, cost of goods, you're gonna compound. It's gonna make a bad problem worse.
Absolutely, and especially now you mentioned Jessica mentioned AI, and it's going to completely change. We'll be having different conversations next year because of it. I mean, think about the evolution and introduction of AI tools, even for pricing. There's that app, I think it's called Fila, where you can literally go on a website, look at an item, and click and see, is it cheaper somewhere else, a similar model. Scan resale sites. I mean, you cannot just be leaning into basic product because you're going to be beat on price if that's the case. So what is separating you? What is your talk track, and what is that innovation that's going to set you apart?
So we only have a couple minutes, so if there's any additional Q&A, please put that into the chat. John, a question for you. You and I feel like for the past 10 years have been talking about the rise of sustainability. So many supply chains have been trying to become more and more sustainable. We've had several conversations, obviously, publicly on this. We look with all these headwinds. Where does sustainability rank in the conversation today? Is it still as important as it was, a few years ago?
Well, it feels like it's been downshifted a little bit, at least at the policy level, but that maybe is not true at the consumer level, and maybe is not as true at the retailer brand level too. If you're looking at, brand identity, I was reading, just the past week or two about some new brands that are coming out that are focused on using 100% cotton with the objective of avoiding microplastics and the potential effects that has, seeping into the body. So I think it's, like I said, it's at the policy level, obviously been de-emphasized, but that doesn't mean that it's no longer important. I think there are still, consumer reasons to pay attention, and also reasons around brand identity to pay attention to.
I would just add to that too. I think, with our members and the large retailers, I think John's absolutely right. Certainly at a policy level, things have shifted, but consumers still, place a lot of importance in particularly some segments of consumer find it very, very important and continue to, rate it so. And even to the point where it translates to actual purchase behavior, which is not always the case. What they say, is important doesn't always play out at, the point of sale, but in some of these segments, it really does. And in terms of, the importance, on the retailer side and their kind of corporate priorities, there are a lot of retailers who have, kind of existing commitments in terms of decarbonization or climate goals or all of these other things, which in large part, the ones that, to be successful at that also have to have a business objective that's tied to that. So in many cases, it's not just decarbonization because like it sounds good and it's a buzzword. It's because there is an actual business, benefit to that, and you're becoming more efficient on your supply chain piece, and you're cutting, out empty miles, and you're being more efficient with how you're moving goods, and you're optimizing your network so that you're shortening, the transit times, and all of these things that are increasing efficiency also translate into a sustainability win. So the companies that are tying those things together and making it kind of a business and bottom line win, it's not just kind of sustainability for sustainability's sake. There's a value to it in a number of different ways, both from a business standpoint as well as the customer kind of importance and relationship.
Kristen, anything you're seeing on consumer data as it relates to sustainability?
I think the consumer has other things on their mind right now. I still think that there's importance, but John said there's a little bit of a de-emphasis, I think, from the consumer's mindset. I think price has really come to the forefront of where consumers are shopping. If they're comparing two items that, two t-shirts, they look the same, feel the same, and one's sustainable but more expensive, I do think in most cases we'll see the consumer trade down a little bit. I mean, I will say we do see an emphasis on values, how brands are communicating their values, consumers aligning with brands that have values similar to their own. So I wouldn't negate your mission as a brand. I think that still is important to consumers, but especially if it comes to cost, we might be, we're seeing a little bit of a shift there.
So we're pretty much up on time. I want to thank, Kristen, Jess, John, and John for their vital insights today. Thank you to everyone in the audience for joining us. Again, this is going to be back up on the site in the next couple of days on HGI. We're going to be publishing across all our channels. If you haven't already, please subscribe to the newsletter at hgi.io, and hope to see everyone soon. Thank you.
Thank you.
Thanks.
Bye.
Good to see you all.